Dudley Do-Right of the Mounties, lonely defender of justice and fair play, handsome, brave, daring, and hopelessly lost.
What? Me steal? Me break the law? Sadly, yeah. But then I'd be Dudley Do Wrong. I'm so confused.
Hey guys, Rafi here from the Endgame Investor, and boy, do I have news for you today. It seems that Bill Dudley, aka Dudley Do Right, who was the Vice Fed Chair from 2009 to 2018, who Wikipedia says is both 68 and 69 years old at the same time, he's coming down on the Fed for not being hawkish enough. He thinks that there should be mega rate hikes and everything will be fine. Sure it will be. Let's go into what Dudley Do Right says. Here we have an article from our favorite guys at Bloomberg. 4 Fed hikes may be just the start as traders boost rate bets. Well, that's going to go on well. 4 rate hikes, just the start. What do you think is going to happen to all the debt and all the asset prices that need to deflate? This is written by Benjamin Purvis, Michael McKenzie, and Edward Bolingbroke. I guess that is a fit name. Kishmo Kenhu, as they say in Hebrew. Here we go. Here we go. The first paragraph. This is just great comedy. The drumbeat for the Federal Reserve to implement 4 quarter-point interest rate hikes this year is growing. The drumbeat. And with the speed that markets have been moving, there's possibility that the traders may soon look to protect themselves against the risk of even faster tightening. Where does Bill Dudley come into this? Some think the Fed has little choice but to become more hawkish. Former New York Fed President Bill Dudley said as wage growth likely spurs consumer inflation, the Fed will have to respond by taking interest rates above neutral well before the end of 2024. And what are neutral interest rates? You say, what does that even mean? It means nothing. It's a made-up term that doesn't exist. There's no such thing as neutral rate. That is the free market rate. That's what it means. Neutral is free market. What is the free market interest rate? It's way higher than -6. That's for sure. Next article on Dudley. Fed forced to run triple option with time running out. Ooh, is that like a football reference? This is by Mohammed El-Arian, who is one of the few Keynesians with a sliver of a brain. Even though his theory is all messed up, he does know that something is very wrong with this picture. Mohammed El-Arian is quoting Bill Dudley again. That situation led Bill Dudley, the former president of the New York Fed, to write for Bloomberg Opinion, "I have news for those who think the U.S. Federal Reserve has turned more hawkish on inflation. It has only just begun." Except here, Mohammed El-Arian is wrong, because once they really do get hawkish on inflation, the entire stock market and bond market and global bubbles everywhere throughout the world are going to implode. And once that happens, they're going to go right back to quantitative easing, and that is when the dollar will die. We're getting very close now. Except Mohammed El-Arian does get another thing wrong here in this paragraph. Because the Fed is moving into uncharted policy waters, says El-Arian, it is virtually impossible to answer with a high degree of confidence 2 key questions. How will the economy respond to the triple removal of monetary accommodation, by which means the end of quantitative easing? And to what degree will financial conditions tighten? Here are the answers to both of those questions with a high degree of confidence. Mohammed. First, how will the economy respond to the triple removal of monetary accommodation? Asset prices across the board will collapse. Stocks, bonds, real estate, everything but commodities, and especially monetary metals, gold and silver. And to what degree will financial conditions tighten? What degree will financial conditions tighten? They will tighten the most that they have ever tightened relative to real money, gold and silver, which will skyrocket in purchasing power and nominally. That's when real financial conditions will tighten. In dollar terms, they will loosen to records, to hyperinflationary records, as the purchasing power of the dollar collapses and the purchasing power of gold and silver, on which the dollar has always been based, will rocket higher. Those are the answers to those questions with a high degree of confidence. Mohammed El-Arian explains his triple option, his football reference. Well, isn't that just great? Here's his football reference. A trip to the playoffs was at stake in several of the weekend's NFL games in which teams were forced into a hurry-up offense. Oh, yes, very entertaining. The stakes are much higher for the Fed. No, really, the stakes are much higher for everyone who doesn't own real money. Stakes are much higher for people who are stuffed with dollars and dollar-denominated assets. That's who the stakes are higher for. The stakes are much higher for the Fed, sure. And therefore, the economic and social well-being. Who on the Fed do you think doesn't have a golden parachute, literally, who's going to flee the country after this entire 50-year bubble implodes? They're going to flee the country. They're going to go into hiding. They'll be fine personally in their little islands. Maybe they'll go to Epstein Island or something. Who knows? They're fine. People who own too much dollars and not enough real money, they're not fine. The hope is that policymakers will do a Tom Brady, he says, and regain control in a reassuring and seemingly automatic manner. The risk, and it is a material one and increasing, is that they could end up more reminiscent of my beloved New York Jets. Well, we can now all relate to Mohammed El-Arian because he speaks football. And here we have Dudley Do-Right coming to the rescue. The Federal Reserve needs to get a lot more hawkish. It can't remain in the fantasy land of its dovish forecasts indefinitely. Yeah, no shit. I have news for those who think the U.S. Federal Reserve has turned more hawkish on inflation. It has only just begun. True, the minutes from the Fed's December policymaking meeting display growing concern. Officials are acknowledging that the labor market is already very tight and that factors such as wage growth probably won't be entirely transitory. They seem to be losing hope that more people will come off the sidelines to satisfy demand for workers. They're looking increasingly likely to raise interest rates immediately after the Fed's asset purchase program ends in March, though there's still the wild card of how a resurgent pandemic will affect the economy. Dudley continues, their median projection for the federal funds rate at the end of 2024 is just 2.1%, well below the level they deem to be neutral. This is a remarkable, even surreal forecast. Inflation won't be a problem, even if the Fed does little to rein it in. That's what he thinks is remarkable, and I agree. I see only a couple ways for this Alice in Wonderland fantasy to come true. And here he goes into reasons that don't really make any sense because his economic theory is all messed up. How high does he think rates are going to go? If inflation subsides to 2.53% as supply chain issues dissipate, then a federal funds rate peak in the 3 to 4% range seems reasonable, but it won't go down to 2.53% because prices have been hiked for January 2022, as many consumer-facing industries have hiked their prices to consumers this January, so the CPI is just going to keep going up and up. Here, Dudley concludes, this is a much steeper path and higher peak than financial markets currently anticipate, roughly double what euro dollar futures imply, except it's going to be even higher than that. Markets are starting to catch on, but only very slowly. At some point, the reckoning is likely to become disruptive, triggering a sharp rise in interest rates and a large drop in bond prices. The taper tantrum may have been merely delayed, not avoided. Now, here's the thing. The thing. What is the thing? The thing is that the Fed can control interest rates at whatever nominal levels they want for however long they want. If the Fed does not let interest rates rise in dollar terms, they will rise in gold and silver terms as the purchasing power of the monetary metals reaches their 100% parity with the Fed's balance sheet, which should bring gold to about $30,000, $40,000 an ounce, depending on how big the balance sheet is by the time this actually happens. That will be a hyperinflation of the dollar. And it will be the end of the current monetary system, and either a return to gold or the breakdown of the global division of labor. This is what Dudley does not understand. But it will happen. My bet is this year. And when it does, all the people on the Fed will be fine with their golden parachutes on whatever Pacific island they run to. But if you're not eligible for a golden parachute, then go get one yourself now.
We've got a heartbeat.
Key, please.
Key.
Where's that damn torpedo?
It's ready, Jim. Lock and load.
Fire.
to be or not to be.
This is Rafi of the Endgame Investor. While we wait for the Fed to unleash their golden parachutes for themselves, you may want to sign up for a 2-week free trial of the Endgame Investor to see how I'm handling this, or you can sign up as my patron on Patreon to get my commentary, my biblical commentary on a libertarian philosophy based on the Bible. And if you enjoy the ideas of liberty, you will enjoy that. In the meantime, go build your parachutes because you're running out of time.